Are you planning to buy a home soon? Most likely you've heard of the FHA loan. And you know what? This loan may be just the one for you. In this video, I'll cover what is an FHA loan, the requirements to obtain one, the pros and cons, and why you should consider this type of loan for your next home purchase. So who or what is FHA? FHA stands for Federal Housing Administration, and they are a part of HUD, which is a federal agency, and HUD stands for the Department of Housing and Urban Development. And from my research, I've learned that HUD has been helping people buy homes since 1934. Now, HUD is a federal agency that addresses housing discrimination, and they provide programs and policies that addresses our housing needs. So you may have heard of Section 8, for example, but in this case, they also offer mortgage insurance. Now, FHA does not provide the money for you to buy a home. They insure the mortgages that the lenders give out. So this allows lenders to take risks that they may not have otherwise have taken on a borrower, because this insurance will pay them back should the borrower default on the payment of their loan. The FHA offers a variety of mortgage products, and they provide FHA insurance for the purchase of a home, the improvement of a home, or for the refinance of a mortgage. But for this video, I'm going to cover the FHA loan in regards to purchasing a home. Now, there are many barriers to home ownership. There's the high cost of living, there's the affordability crisis, and there's low credit and not having enough savings to buy a home. So this FHA loan is very appealing and attractive to home buyers because it addresses two of those barriers. If you don't have a lot of savings, or if you have a low credit score, this loan is very attractive to a lot of home buyers because it allows for higher DTIs and lower credit scores and lower down payments. There are minimum requirements that the government sets for FHA borrowers. So they are 3.5% down payment with a 580 or greater credit score. So that means if you buy a $200,000 home, you have to put down $7,000. So that is 3.5% of $200,000. If for a $250,000 home, that would be $8,750. For a $300,000 home, that would be $10,500. And for a $400,000 home, your down payment will be $14,000. You have to put down 10% if you have a credit score between 500 and 579. And then there's your debt to income ratio. So let me explain. There's a front end debt to income ratio and there's a back end debt to income ratio. The front end debt to income ratio is solely made up of your debt related to housing divided by your income. So your housing debt would be your principal payment, your interest payment, taxes and insurance, any HOA fees, and the mortgage insurance premium. So add it all together, divided by your income, that would be your front end ratio. For FHA, if you have a 500 to 579 credit score, that front end ratio has to be 31% or less. If you have a credit score of 580 or higher, that ratio can go up to 40%. And then there is your back end debt to income ratio. Your back end debt to income ratio is made up of that housing expense that I just talked about, your principal, interest, taxes, insurance, HOA fees, mortgage insurance premiums, and any other monthly obligations on debts and liabilities that you have divided by your income. So if you have a credit score of 500 and 579, that back end ratio can be as high as 43%. If you have a credit score of 580 or higher, that back end ratio can go up to 50%. Now, to get the higher ratios, not only is your credit score considered, but they want to see that you have other compensating factors such as cash reserves, residual income, or significant additional income that's not reflected in your normal income that they're using to calculate your DTIs. If you want to know about DTI ratios, watch this video here where I tell you how to calculate your debt to income ratio and tell you more about the debt to income ratio. And then there's your income and employment history. So there's a HUD handbook that is like the Bible for the lenders to use, where they will reference and they have pages and pages of various sources of income that they will consider. Foster care income, retirement income, rental income, salaried, part-time, seasonal, all types of income is considered and outlined in this handbook, and then there's requirements to be able to accept those. But generally, your different sources of income will be considered if the source of income has existed for a defined period of time and is steady, consistent income that is reasonably likely to continue. They will use it. And so typically consistent, steady employment for at least 2 years is required. Now let's go over the requirements for the property, because this is important and there are many requirements. The property must be located within the U.S., Puerto Rico, Guam, the Virgin Islands, the Commonwealth of the Northern Mariana Islands, or American Samoa. The owner must occupy the home as a primary residence for at least a year. No investment properties, so no second homes or vacation homes. FHA will not insure that mortgage. A property that is being resold by the current owner within 90 days of them acquiring the property will not qualify for FHA insurance. So, for example, if you are looking for homes and you found a home that you want to put an offer on, FHA will not insure your loan if it is noted that the current owner has only owned the home for 90 days or less. I'm trying to think of reasons why they will have this restriction, except maybe they're just discouraging flipped properties, the purchase and the owning of flipped properties. That's the only reason I could think of. It's so kind of in line with they don't insure investment properties, second homes, vacation homes. They also don't have an interest in providing assistance to people buying those type of homes either. So a home that was flipped. The home must be a single family home, detached or semi-detached, or multi-family up to 4 units, as long as you occupy one of the units. It can be a manufactured home as long as it is designed to be a dwelling with a permanent foundation. Condos, your condo or the development that condo is a part of has to be FHA approved. It could be a mixed use property. So a mixed use property are properties that are a combination of retail and residential, office and residential, commercial and residential. So those are considered mixed use properties, and those may qualify if 51% of the square footage of that property is used for residential use, and the commercial use or the additional use of the property does not affect the health and safety of the residents. The property must pass FHA's minimum property requirements and standards. So an appraisal will be conducted, and the appraiser will come out and make sure that these standards are met. So the home must have working appliances, water, heat. So those are just some examples. A stairway must have the proper railing. So the appraiser will come out and check for those things. The property must meet FHA loan limits. So I'm not going to get into what those limits are, but they vary by location. You can go to HUD's website, hud.gov, hud.gov, or you can contact your lender, who will be able to let you know if the property meets the loan limits. If you're enjoying this video and I'm dropping gems or providing valuable information, please subscribe or like or comment. I would really appreciate it. So let's get into the pros of an FHA loan. The FHA loan is very flexible. You can have a low debt to income ratio, a less than perfect credit score, and you can put down a low down payment as low as 3.5%. Now I know some conventional loans offer the opportunity to put down only 3%, but they usually have more strict guidelines to qualify to put down 3%. And then there's the VA loan where you put down 0%, but you also have to be a veteran or an active duty service member or closely related to one. And then there's the USDA loan where you could put down 0%, but you are restricted to certain areas that are considered rural. So the FHA loan doesn't have those requirements. Your down payment can be in the form of a gift, and you can use down payment assistance. And the down payment assistance can be used in tandem to your low 3.5% down payment, so making it easier to afford a home. You can use the link in my description where I have a video about down payment assistance programs. The FHA loan is a great loan to use if you're interested in acquiring rental properties, because in most cases, to buy a multi-unit property, you have to put down way more than 3.5%. But with the FHA loan, you can acquire multiple doors with just 3.5% down if you just live there for a year, and then you can move out and rent that apartment that you were living in. And it's not just for first-time home buyers. That is a popular myth with FHA loans. You do not have to be a first-time home buyer to take advantage of this great loan. And then there are cons. The FHA backing is funded by you, the borrower. So with that, there are fees. There is an upfront mortgage insurance premium that you have to pay when you close on the loan, and that could be rolled into your financing, or you could pay out of pocket at closing. And then there's an ongoing mortgage insurance premium that you have to pay usually for the lifetime of the loan. The upfront mortgage insurance premium is 1.75%, and the ongoing annual mortgage insurance premium varies and can range from 0.15 to 0.75% depending on the loan term, the down payment that you have, and the loan amount. And it is paid for the lifetime of the loan, so it doesn't end unless you refinance out of that loan or the loan is paid off. In one circumstance is if you put down more than 10%, you can have that mortgage insurance premium terminated after 11 years. And so here's an example calculation of how much this mortgage insurance premium can add to your monthly housing payments. Let's say your loan amount is $250,000. That excludes your upfront mortgage insurance premium if you're choosing to roll that into your financing. And let's say you're borrowing that amount for a 30-year term and your down payment was 3.5%. In this case, your mortgage insurance premium will be 0.55%, and it will be for the life of the loan. So $250,000 times 0.55% equals $1,375,000 for the year, or an additional $114.60 added as a monthly housing expense. So there you have it, all about the FHA loan, what it is, the requirements, the pros and cons, and why you should consider it for your next home purchase. I used the FHA loan when I bought my second home, and many of my clients have acquired their home using an FHA loan. It is a great loan. It's flexible. You can have a lower credit score. You can have a higher DTI. You can have a low down payment and be able to get into the home of your dreams. To apply for an FHA loan, just reach out to any FHA approved lender and they can help you with getting that loan. If you enjoyed this video, please subscribe. I provide many videos on housing and real estate related topics, and I'd love for you to be a subscriber. Have a great day.